It's time to wake up and take a look at your super. You could be sitting on a monster. With the latest Australian Retirement Trust app, managing your super is easy. Check your balance, control your contributions, and track how you're invested, all in just a few taps wherever you are. Plus, get notifications and handy tips. Download the new and improved Australian Retirement Trust app today to find out if you're sitting on a monster. Get it now on the App Store and Google Play and see what your super's been up to.
Good evening, everyone, and welcome to our second Retirement Essentials webinar. Or for those of you who are joining us for the first time, welcome to this experience. My name is Josh Van Gestel. I'm the Senior Manager of Education here at Australian Retirement Trust, and I really want to acknowledge all of you for taking the time to learn more about your superannuation, your retirement. Now, I'll get into tonight's event shortly, but before we do that, I'd first like to acknowledge the traditional owners of the lands from which we are all joining this evening.
At Australian Retirement Trust, we're here for all Australians, today and every day throughout your working lives in retirement. We acknowledge that we work and live on the lands that have been cared for by Aboriginal and Torres Strait Islander people for over 65,000 years. At Australian Retirement Trust, our communities span far and wide, from Yanjin and Warren in the east to Boorloo in the west, to Naarm and Lutruwita in the south, and as far north as Zenith Cass. As we gather today, we acknowledge the traditional custodians of these lands and waters and their continuing connection to country and community. We pay our respects to elders past and present and to all Aboriginal and Torres Strait Islander people. We recognise the diverse cultures, laws and elders across Australia. We strive to listen and learn from this legacy to help create a better future for all generations, no matter where you are or where you're from.
As we go into tonight's presentation, please be aware that the information we're covering is of a general advice nature only. So please consider it for your own circumstances, and I'll also let you know in a moment and towards the end of tonight about how you can seek further guidance, including financial advice where it's pertinent, to make sure that your needs are being addressed. Now, as I said, this is the second in our series of this webinar, and tonight we're going to focus on actually talking about how you can grow your superannuation. In the first episode, we talked about planning for retirement and assessing whether your needs would be met throughout your super. But tonight, we're going to talk about what you need to do if you don't have enough. So there are a couple of things that we'll be focusing on this evening. The first is looking at how you contribute into your superannuation. And the second is thinking about how you're invested, not just in building your savings for retirement, but also in making sure that you're invested the right way as you move through and into retirement. Now, we're sure that this is going to raise a number of questions for you, and we really encourage you to be taking advantage of our moderators who are online tonight. Put into the chat or the Q&A any questions that you have. We also have the digital workbook that you would have had access to. Please make sure that you're completing that as we work through tonight, taking notes and experiencing some of the tools that we make available to you. We also encourage you to reach out to speak to one of our advisors if after tonight you would like to seek further guidance, or where you have your own financial advisor, we encourage you to reach out to them and engage with them. So before I hand over to one of our key specialists that's joining us tonight, Ruth Weaver, who is the team leader of our key client education team, I'd just like to firstly reflect on something that we talked about last week. that if you don't have enough in your super for your retirement, once you work out your income needs, how much you'll need, but also how much you want, there are really 4 steps that you can consider. You can think about your retirement age, whether you actually have to delay retirement and work a little bit longer to make sure you save more for your retirement. The second thing you can do is think about your income needs for retirement. Can you actually reduce the income that you are looking to spend in retirement? The third is to also just think about what your super can be doing for you. Can you be actually putting more into super now while you're still working, or for that matter, after you've ceased working? And finally, how are you invested? Are you invested in such a way that your super will be protected to make sure that you're not concerned, but also to ensure that your super is growing for you? Now, Ruth is going to cover off quite a bit of information to do with contributions, but I would say to you that there is also a personal consideration you have to make with what Ruth will be going through. I would encourage you to visit our website to understand what those rules and conditions are. Your age will be an important factor in how you can contribute to your super, when you can contribute to super, but also the age at which the rules that will apply to that. So on that note, I will hand over to Ruth to cover off contributions for us.
Thank you, Josh, and good evening, everyone. Welcome and thank you for joining. Now, I'm going to talk to you about various different ways that you might think about putting money into your superannuation, be that before tax or after tax. And we'll run through the different ways and the different reasons you might consider using either form. We're going to start this evening by talking about concessional contributions. Now, concessional contributions are the type of contributions that most of our superannuation balances are made up of. If you think about it, it's concessional because it's generally taxed at a rate of 15%, which, if we compare that to those of us who are working, is often a lot lower than our marginal tax rates. Now, concessional contributions are generally made up of 3 different types of contributions that might be paid into your account. Firstly, and probably the most common, will be the contributions from your employer. That is where most of us are getting the contributions fed into the accounts from. Now, sometimes we will make contributions ourselves, and that can be, from a concessional perspective, done in 2 ways. The first and probably the most common way that most of us would contribute to our accounts when we're working is through salary sacrifice. So that's where we're approaching our payroll departments, for example, and asking them to redirect some of our pre-tax income into our superannuation. And then sometimes we can put money in from our bank accounts and therefore claim a tax deduction on them. And it's almost like a DIY version of salary sacrifice where maybe you don't want to involve the payroll department. The end result is exactly the same. Now, all 3 of those contributions, regardless of which type is going into the account, are subject to a limit. And we all have an annual limit under this type of contribution of up to $30,000 a year. Remember, it includes all 3 of those contribution types. So let's work through each of them separately quickly. Firstly, the employer contributions. Now, as I'm sure most of you are aware, particularly if you're still working, that the employer compulsory amount of contributions has increased and did come into effect on the 1st of July at a rate of 12%. Now, that has been gradually increasing over the last couple of years. So we're currently sitting at 12% of your income also being contributed into superannuation. It's in addition to your income. Now, depending on where you work, if you do work for Queensland Government, for example, there can be different rates depending on which department you might work in. Now, this can also be true of the private sector. There can sometimes be employers who might choose to make additional contributions. So it is safe to say that just look at your own employment, look at your conditions and understand what your rate is. At a minimum, it should be sitting at 12% of your income contributed in on an annual basis. So that's the first type of contribution that forms the concessional bubble, and it's probably the type of contribution that is the most common going into the fund. Now, remember I said these types of contributions are taxed at a rate of 15%. We call them concessional because that's a lot lower than most of us are paying on our tax rates. So let's just look at the personal marginal tax rates that exist in this financial year for Australians. And they could be as high as 47%. If you're earning above 190,000, for example, that salary above that rate could be taxed at 47%. So suddenly 15% does look quite attractive when we're talking about superannuation. And this is often why people do like to try and take advantage of that concessional tax rate. Now, we do understand that if you're a lower income earner, for example, and you're, might be only working part-time, maybe 15% tax is not so attractive. So there is a system called LISTO, and it's really designed to compensate those who don't get the same benefit from that that 15% tax bracket, because maybe your marginal tax rate is actually quite low. So it's just making sure that there's a reimbursement there for individuals. So that's the employer contributions. Your first point of call is to work out, well, what is that on an annual basis, depending on my employment? The second then is to think about salary sacrifice. This is probably the most common way that people contribute into their own superannuations. And if I can put it to you this way, to arrange a salary sacrifice, you're probably going to do that with your payroll department. And it's really by a way of saying, look, instead of having this income come through to my bank account, I'm going to redirect it into superannuation. Now, if you think of someone earning over $190,000 a year, that $100 or that last $100 could be taxed at up to 47%. So that's really showing you the benefit that only paying 15% tax may have on you, which is why salary sacrifice is very popular. So that $100, instead of being taxed at up to 47%, for example, might be only taxed at 15% on the way into super. Now, sometimes people will say, well, I don't have a payroll, or I wasn't organised early enough in the financial year to take enough advantage of this. What can I do? Well, you can actually do it yourself by putting money in from your bank account and then claiming a tax deduction on that contribution. The end result is the exact same benefit as if you had actually salary sacrificed. Now, this was very popular for people who were self-employed. So if you're self-employed or you're with a very small business, for example, maybe there is no payroll department, and maybe this is the easiest way for you to do it. So an example might be you put your $10,000 into superannuation and then you claim your tax deduction on it. And you're effectively telling the super fund, I want that to be taxed at 15%. And I'm going to get back all the tax that I've already paid on that. So the end result of this system is the exact same as if you had salary sacrificed it. Now, you do have to be very careful that if you are going to claim a tax deduction, you need to make sure the fund has the money for that financial year. The next step after the contribution is made before 30 June is to tell the super fund before you do your tax return that I intend on claiming a tax deduction on this money. The super fund will then change the type of contribution from an after-tax or a non-concessional to a concessional, and then you can claim that in your tax return. So there is a process there. The very first thing is to get the money in before 30 June, then tell the super fund your intention to claim the tax deduction, and then you actually do your tax return. And like I said, very popular as well, but more inclined for people who might be wanting to do a lump sum, or maybe those who work with a small organisation who don't have a payroll department. Now, we talked about 30,000 being an annual limit that we all have, but like everything in super, there's always an exception to the rule, and this is no different. And what is worth noting is that for some people, we can look back on previous years and maybe use some of the unused limits that we've already have. So let's take a look at this. Let's assume that we're in this financial year, we're in the 25-26 financial year, and our employer contributes 12,000. Maybe I earn 100,000. I'm getting the minimum amount in, which means another 12,000 put into my superannuation. That would mean that I can contribute up to 18,000, and I might do that by salary sacrifice, or I might put the 18,000 in as a lump sum and claim a tax deduction, or maybe a bit of both. But I have 18,000 to work with after the 12,000 from my employer. But in some instances, I might not be just limited to the 18,000. Now, this will be different for everyone, so just be very careful that this doesn't apply to every individual. There's a couple of things to be mindful of. First and foremost, if your balance is under $500,000, there may be an opportunity for you to do more than the 30,000. And this is in an instance whereby you have not used your full concessional amount of 30,000 in the previous year, for example. So in this instance, we can see that there is an unused amount. We didn't quite get to that 30,000 last year. So when we came to 1 July this year, we start with our 30,000 plus whatever we didn't use last financial year. Now, in actual fact, we're not just looking back at last financial year. We're actually looking over a rolling 5-year period here. So if you're an individual who might have never contributed to super before and you were only getting your employer contributions, unless you're a very high income earner, you maybe never met the threshold or the 30,000. Now it used to be 27.5, so just be careful when you're doing your own calculations. But what it actually means is you may not be limited to the 30,000, but it's so important that you remember this is only applicable for those who have less than $500,000 in their balance. Now, a couple of things to be mindful of. If you are tracking close to that balance, maybe it's time to pay attention to see, could you be taking advantage of this opportunity now before your balance does go over the $500,000 threshold? Also, if you've got a financial year, maybe 4 or 5 years ago, where very little contributions were made to super, that unused amount won't be there forever. Remember, it's only a 5-year rolling period. At some point, when we go back as far as 2018, 19, 19, 20, those unused amounts will be gone. So effectively what happens is the oldest year will get used up first. So if your big window is sitting back in those financial years, there is a clock on this for you to take advantage of those unused amounts. Now, the most common question we get here is, how will I know? How will I know if I have any of this and how much it's worth? Do I really have to go back over the last 5 years worth of statements to figure this out? No, you don't. If you log into your MyGov account, they're actually calculating it for you. So if you go to your MyGov account, go to the superannuation section, they will actually show you the carry forward amount and you'll be able to see that figure in real time. It's a much, much easier way of determining whether you can go above that 30,000. So it's a beautiful opportunity. If you can take advantage of it, be mindful of the super balance and also the financial years where you're actually bringing those unused amounts from. They don't last forever. Now, just keep an eye on your online accounts. If you're tracking towards close to the limits any financial year, you'll be able to see that in real time through the mobile app or through your accounts online. Remember as well, your statements are all tracked in there. So if you do need to go back and maybe have a look at your statements, please do that. If you're a defined benefit member, sometimes it can be trickier. It's not quite as simple as saying 12%. Remember, defined benefit members are that older style product. So just refer to your fact sheets that you would have to help you work out your notional contributions. That's what we call them. Or give us a call and we can do a quote for you if you're really not sure. But remember, MyGov is actually tracking a lot of this for you. Now, that's the first way, the most common way that most of us are getting money into superannuation because we like the 15% tax. However, there is quite a limit on that, particularly as you're getting closer to retirement. Maybe the mortgage is paid off, the kids have left, there is a bit more disposable income. And this is the time often that people really want to focus on super and really want to build it up. And often you find that you're handcuffed a little bit with that 30,000 limit. Remember, it's not just that one. There is also what we call after-tax contributions. So this is the type of money that goes into your superannuation from your bank account. Now, generally, I will say if money is in your bank account, you've already paid tax on that. You don't get your pre-tax amount into the bank account. It's after your marginal tax rate has been applied. So that will not be taxed on the way into superannuation, and it's never taxed on the way out. It's already taxed money. Because of that, there is actually a bigger limit attached to this. There's a far more generous amount you can put into your superannuation this way. And that's actually 120,000 per person per annum. So it really means that, yes, you've got your 30,000 over here, but in addition to that, you can also get 120,000 in each financial year. And again, there is some age limits around here. So once you get over the age of 75, it is very difficult, in fact, almost impossible for any money to be put into your account. So again, think about your age here when it comes to contribution strategies. It's a very relevant factor and a very personal one. Now, the 120 might seem quite a lot, and it is, particularly on an annual basis. But often we find it can be quite restrictive, whereby you might come into a lump sum. Let's suppose, for example, you get an inheritance or you've sold an investment property and you're wanting that money to be contributed into your superannuation. Well, you might want to take advantage of what we call the bring forward rule, which really allows you to use 3 financial years worth together. But you're looking into the future here. You're bringing your next 2 financial years worth of 120s with you. And what that really means is that you can get $360,000 in one hit into your superannuation account. Now, there are some criteria here. Your balance is one and your age is one, but generally speaking, they are the rules. So you're using your next 2 years, financial years worth here. I usually say to people a quick tip, because it can be confusing. When I talked about the concessional contributions and the ones where we considered tax deductions, you're looking in the past. The reason you're looking at the past 5 years is because you cannot predict your tax liability into the future. So if you're thinking about tax deductions and which years am I using, you're only looking into the past, because that's the past. We know what you paid in tax and what you've earned. We can't predict that or qualify that for the future. So that's the tax concessional type. When it's the after-tax type, you're looking into the future, your future financial years. So just a quick tip on that one. Now, there's also some government incentives to put money in after tax, which I'll cover in a moment, and they are generally designed to be attractive to lower income earners. I mentioned age is an important factor. So generally when you hit 75, you can't get any more money into your superannuation. Before that, though, you generally can contribute after tax, and concessionally, of course, if you're still working, you will still be able to take advantage of the concessional. There are some criteria to meet. But your balance is becoming more and more a pertinent factor when it comes to making a contribution strategy. So if you did receive an inheritance or you did sell an investment property, for example, and you're wanting to take advantage of the $360,000 3-year amount that you can put in after tax, you need to be mindful of your balance. So you do need to think about how close to the $2 million mark you are. You cannot contribute to your superannuation after your balance hits $2 million. Now, your balance can grow beyond $2 million because of investment returns, but you couldn't make an after-tax contribution if your balance is already at that level. Now, you effectively, to get the full $360,000 in, you'd have to have a balance of less than 1.66 million. And then, of course, it tapers depending on your balance. So before you go and make a large contribution into your super, think about your age, okay? Are you in your 70s or getting to your mid-70s? You need to be mindful of that, and then think about your balance. Now, I talked about some government incentives, and generally these are targeted at lower income earners. And the government recognises, for example, if you're a low income earner, and we're talking about salary sacrifice and the 15% concessional tax and all the tax you save, not very attractive for someone earning 40,000. They would probably barely pay 15% tax anyway in their overall tax. So let's have a look at the government co-contribution, which is really targeted for those lower income earners, whereby your salary is under 62,500 a year. You may be able to take advantage of some of this. If you can get $1,000 throughout the financial year into your account, and it doesn't matter how you do it, you might have a BPay payment for $20 a week going into your super. You might do it in one hit. But if you're able to contribute $1,000 throughout the financial year into your account, you may be rewarded by the government through the co-contribution scheme of up to $500. Now it tapers, so the full amount is $47,500. You'd get the full $500, and then it tapers out once you get to $62,500. You would no longer be eligible for co-contribution. Okay, so just think about whether you or your spouse or someone in your household is within that income level and whether or not you could take advantage of it. There's lots of information on our website about the eligibility criteria for the government co-contribution. Now, there's another one called a spouse contribution. Again, it's thinking about those lower income earners who don't get the same benefit from 15% tax. So if, for example, there's two income earners in the household, a high income earner and a low income earner, often the high income earner can be rewarded for putting money into the lower income earner's account through the spouse contribution, the tax offset for spouse contributions. So if you can, as a higher income earner, if you put $3,000 into your spouse's account, you may be rewarded with a tax offset of up to $540 simply for doing that. So if you think about the government co-contribution and you think about the spouse contribution, you may be in a window of time to be able to take advantage of both of those. So out of that $4,000, $1,000 for the co-contribution, $3,000 for the spouse contribution, that can give you an immediate return of $1,000, which is not bad when you look at it in that way. So think about whether you do meet the eligibility for that. Now, when we talk about spouses, we do often get asked questions about redirecting some of your balance towards a spouse account, and people talk about contribution splitting. Contribution splitting is really just redirecting your concessional contributions. So these are the ones that your employer put in, that you made salary sacrifice contributions for, and just redirecting some of that over to your spouse's account. Maybe you've worked all of your working life, but your spouse might have stayed home and helped rear children, for example. And now you're thinking it might be nice to redistribute some of that across to a spouse. There's no immediate tax benefit for it, but in the long term, it may give you some Centrelink benefits. It may be helping you to just redistribute wealth between both of you. So it's a lovely little strategy if you do want to build up the balance, but maybe your spouse just isn't in a position to be able to get contributions from an employer, and you can redirect yours to their account. The question that often comes with this one is, well, does that mean that I can use more, get more in concessionally? And the answer is no, you can't use both concessional amounts. If you have a spouse, you still have to count anything that goes in concessionally towards your 30,000. You don't get a second dib at it. And the last one before we come back to Josh is about the downsizing rule. We get a lot of questions about this in our seminars. And this is a relatively new contribution strategy. So everything I've talked about so far, whether it's your age or your account balance, all of those things, the downsizer is the exception to them. You are also able to contribute an additional $300,000 to your superannuation in the event you sell your principal place of residence as an attempt to downsize your home. You can do this from the age of 55. So whereby you are going to downsize, you've already used all of your concessional bubble, you've done your 360,000. Well, there's an additional 300 that is separate to all of that. So essentially, I met an individual yesterday who was going to take advantage of this. They did receive an inheritance, used their 360,000 to make the after-tax contribution, but was also actually selling their property and didn't realise that this 300 is actually separate to the 360. So look, the message here is there are lots of ways to get superannuation, to get money into your superannuation, but there's also a lot of factors to consider when determining what might work best for you. Now, the Downsizer has a great amount of information on our website. It talks you through all the eligibility on how to get money in and who can qualify for this. So really just go to the website and just type in the words Downsizer on the search button and you will get all of that information. Don't forget to use the calculators as well. So sometimes if you're trying to determine, well, which would give me the better result, should I go in concessionally before tax or after tax? If you hop onto the website, there is a beautiful calculator. It's a contributions calculator and you can put your details in, your income, your balance, how much you'd like to contribute, and it will actually work out for you the overall benefit you'd have and what that benefit will translate to you in retirement. So if you do have a good few years left of working ahead of you, beautiful calculator to be able to predict the impact making those contributions can have on your overall retirement and the income you can generate through that retirement. Lovely calculator. Now, I do know that's a lot. We will come to questions at the end, so I do predict we'll probably field a few on these contributions, but that is only one of the levers that you've got with your superannuation to boost it as you're leading into your retirement. The other one, of course, was investments. So I might go back to Josh now, and he's going to talk us through some investment principles to be mindful of.
Thank you very much, Ruth. I really encourage you to, if you've got questions, there is a lot to digest, please put those into the chat. We have moderators with us and we'll also do a Q&A shortly. What I'm also going to do shortly is hand over to a recording that our wonderful chief economist made for us. He's actually at the moment over in Europe looking at some important assets that we invest in on your behalf. But before he flew out, he made sure to record an update for you all. But before I do pass to our chief economist, to Brian Parker, I'd just like to set up a bit of what he's going to be discussing. Now, for many of us, this year has been a dramatic year, and it has been a year that's gone very, very quickly. It hasn't been a smooth ride when it's come to investment markets. And what Brian will reflect on in a couple of minutes' time is the fact that we've had a year really of two halves. We had a dramatic downturn with share markets at the start of the year when there were announcements around tariffs and as we've seen a lot of geopolitics play out. And this caused a lot of panic, not just with our members, but in regard to superannuation in general. For most superannuants, for most people accumulating their money in super, they've probably got about 50% of that exposed to share markets unless they've chosen otherwise. So this dramatic downturn did have an emotional impact and also an impact on members' balances. But what we saw as quickly as markets fell, we also saw them dramatically recover and almost get used to a new normal that we were seeing in geopolitics. And this is something, as I said, that Brian will unpack in more detail later. But it's important to know that in this context, something that happened over a very short period, a lot of people made some pretty big decisions around how their super was invested. And they made those decisions in regard to a short-term view. It is important that you remember a few key things in that regard. Firstly, that your super is exposed to markets like share markets, as I've just described, but that as those markets fall, they also give great opportunity, as we've seen historically, for growth. So it's important to also think in that context that your super is a long-term investment. Unlike the way we tend to think about other investments in what they're doing this month, this quarter, this year, or even over a couple of years, with super, you should really be thinking about what it's doing for you over decades. In my case, I'm currently 50 or just over, which means I've had about 30 years in the superannuation system. The reality is my money will probably be invested in super for the next 30 years or more. So I should consider my investment journey in that way rather than what's happening in markets over recent months. The other thing, though, and I'll come back to this after Brian speaks, is to remember that you do have choice when it comes to your investments. So Brian will talk about a lot of the assets that we invest in, what he's seeing happening with the economy and how that's affecting the way we're investing your money. But I'll come back after that and talk about some of the choices that you have, as well as the considerations that you can make in choosing the right investments for your superannuation. Now, just before I hand to Brian, he is going to be talking about a whole range of different assets. He's going to be talking about share markets. He's also going to be talking about cash, bonds, but also what we call unlisted. When Brian speaks, keep in context that he'll be talking a little bit about the returns that they've had, but also talking about the risk exposures. Where you see assets generating greater return, typically it means that there is a greater risk for investing in them. But we don't take those risks without consideration. We take those risks in thinking about a long-term objective about what we're trying to achieve for you. On that note, I'd like to now hand to the pre-recorded video that Brian Parker has done for us.
I'm going to go through what's been happening in financial markets this year, but in addition, I'm going to spend quite a bit of time talking about the very long-term returns from superannuation, because at the end of the day, as Josh has said, super is one of the longest-term assets any of us will ever have. In fact, perhaps the longest-term asset we will have. So this really combines two of Josh's charts into one. This is what share markets have done so far in 2025. It has been a wild ride. So on the 2nd of April, when President Trump hosted what became known as Liberation Day, and he announced the tariffs, the longer the president spoke, the further down share markets went. And then within a week or two, those tariffs were put on hold, and all of a sudden share markets recovered very, very strongly. And since then, we've seen share markets again continue to deliver good returns by and large, but it has been a wild ride. I think there's a couple of takeouts I want to highlight from this chart. One is trying to predict these short-term movements in markets, both when they start and when they end, is almost impossible. And it's a theme I'm going to return to towards the end of my presentation, talking about how we invest your money. And one thing that we can't do is that we can't really design investment strategy, especially a long-term investment strategy, based on our ability or anybody's ability to try and forecast these very short-term market events, because essentially they are unforecastable. And also the performance of share markets did show up in the performance of our investment options. So what I've done here on this chart is just show you what our single asset class options that we offer members have done in 2025. Australian shares and international shares, but also the black line there is the performance of bonds. And what we've seen is initially a very, very sharp fall in the performance of these share market linked investments, but they also benefited from the recovery in share markets that we've seen since then. And in fact, we're now basically ahead of where we ended 2024, despite all that volatility and despite the noise that happened in the first half of the year. Now, I do want to take a much, much longer term perspective with this. And what I've done on this slide is to show you the performance of the major asset classes that we invest in, what their performance has been over the past decade or the 10 years leading up to the end of 2025. And there's a couple of observations here. Firstly, the last decade, by and large, was a very good time to be an investor, as long as you were an investor that was prepared to take relatively higher levels of risk. Share markets did very, very well. Private equity investments did well. Infrastructure investments did very, very well. So double-digit returns over that decade. If you were prepared to accept relatively higher levels of risk with your investments, you were handsomely rewarded for doing so. But at the far end of this chart, though, it's a much more depressing story. If you were a more conservative investor, then not only did you not get well rewarded over the last decade, but in many ways you were actively punished for your conservatism, because the returns we've seen from cash, from Australian and international bonds, and from term deposits have been very, very poor. In fact, they've been less than the rate of inflation. So in real terms, you went backwards after investment returns if you were a more conservative investor. Now, the good news, though, is that the silver lining to the cloud of higher interest rates, if you like, is that the future returns now from a lot of those very conservative investments now looks considerably brighter. I'll return to that theme shortly. But I also wanted to stretch the superannuation journey over a much longer time frame. So what I've done here is I've gone back to 2002, which is frankly as far back as I could get the data. So I'm not cherry picking the time horizon here. And I want to assume that back at the end of 2002, I decided to put $10,000 into a range of different investment options. I did nothing else. I didn't take any money out. I didn't make any other contributions. I just put my $10,000 there and I left it. Now, if I was prepared to accept that superannuation is a long-term investment journey, and that if I was prepared to accept that share markets will go up and down and that volatility is inevitable, it's part and parcel of any long-term investment journey, was I rewarded for taking that additional risk? And the answer is generally yes. My $10,000 has now turned into $62,500 as at the end of June. It was a wild ride from time to time, but if I was prepared to look through those short-term periods of volatility, the reward I got was a very, very good longer-term outcome. Now, again, what if I look at that and say, look, that's a really nice return, but if I had to accept that amount of volatility, I would frankly lose sleep at night. And sleeping at night can never be overrated. So let's assume that I just want a somewhat more conservative investment journey. So if I go down the more conservative investment options on this list, starting with our balanced option, the conservative balanced option, and then the conservative option, the further down I go, the exposure to global and Australian shares gets reduced, and the exposure to more conservative assets such as cash and fixed income goes up. Now, the further down I go, I am likely to sleep somewhat more soundly at night, but there is a trade-off. It means the returns I'm going to get over the very longer term are going to be more modest. Now, perhaps the most important line on this chart is the last one, and that's the CPI. At the end of the day, it's our job to generate long-term real returns for members, after tax, after fees, and most importantly, after inflation. Because it's those real returns which will actually determine what sort of a lifestyle we're going to have in retirement. And certainly in the last few years, we've seen a massive shock in the form of sharply higher inflation rates. And for many people, it's the first time they've seen inflation, in other words, a very broad-based acceleration in prices. It's the first time they've seen an environment like that in their lives. The real returns is really what matters. Let's assume that 10 years ago, you picked up a product disclosure statement, or you went on the website and you picked up a product disclosure statement. Well, firstly, congratulations. That's a good start. And then let's assume you did something even more remarkable. You actually read it. And if when you read that document and you looked at the range of investment options that we offer, there would have been a line in there that said, this is the real return objective. This is the investment objective. In other words, we're communicating to members in that document what sort of returns after tax, after fees, and after inflation do we believe are realistic and achievable over time? And it's our job as an investment team to meet that objective and preferably exceed it. Now, 10 years forward from that day, how have we fared? Well, this shows you the range of diversified investment options that ART offers. And all of these options have either met or exceeded their real return objectives. So the blue line is the return of the option, the blue column, I should say. And then the red column is the real return objective that we set a decade ago, plus 2.8% inflation, because that's the inflation rate Australia experienced over that decade. So that very, very strong performance we've seen from share markets over the last decade certainly has supported superannuation returns, particularly here at ART. Let me go talk a bit more about inflation because, as I said, the last few years has come as a massive shock to many, many people because let me do a little thought experiment with you. This is the longer run history of Australia's inflation rate, going back to the early 1970s. Now, I want you to think back over the course of your life and ask yourself, how old were you when you first became let's say, economically aware, or at least aware of the purchasing power of money, if that date in your mind was any time after about 1993, then when it comes to inflation, this has been your first rodeo. You've actually had 30 odd years where the Reserve Bank basically achieved its inflation objective, where inflation was pretty much spent most of the time within the 2 to 3% target band. Then post-COVID, we certainly saw this massive acceleration in inflation. We've now got inflation back in the target band, which is terrific. But I think that inflation shock is a real reminder that when it comes to investing money, it's the real returns that absolutely matter. Now, here at ART, we spend a fair amount of time looking at what's happening in markets, but we don't really spend time trying to forecast the very short-term market moves because we don't think that's really forecastable. But we do spend a lot more time thinking about how the world might evolve over the next decade and beyond. The average age of an ART member is somewhere in the area of about 40 to 45, which means on average for our members, we're going to be investing their money for many, many years to come. And so when we think about the environment the world is going into over that period, this is where we see things playing out. We think we're going to be in a less globalized world, a less connected world, a world where you're likely to see more disruption, whether it's because of technology and the rise of artificial intelligence or climate or geopolitical developments, all of which we've seen in recent years. That adds volatility to the economy and also to financial markets. It also means that there's going to be increasing calls on government to step up and help contribute to the solution to these problems, whether it be climate, whether it be high levels of defence spending to counter what is a very, very fraught geopolitical environment, but also to help people adapt and adjust to often very, very rapid technological change. We also think it's going to be the kind of environment where we're likely to see more frequent bursts of higher inflation. We're certainly not expecting a return to the 1970s or anything like that, but we do think that in a more volatile environment, a less globalized world, and a world where you get more significant disruptions, is a world which has the potential to be inflationary. We do think that central banks will end up succeeding in actually achieving their inflation objectives, which is why when we think about the longer term projections for inflation, we basically assume that the central banks will get it right. But it's going to be a harder task over the next 10 to 20 years to keep inflation down than it was over the previous decade or so. If you think about the decade leading up to COVID, that was really a period where, if anything, the central banks were having trouble getting inflation up. So let's go through some of these longer term trends and what they might mean. This is globalization in a chart, believe it or not. This just shows you it's the ratio of world trade as a percentage of GDP. And it goes back to the early 1960s. What we saw was about 4 decades where world trade basically outstripped the rate of growth in the global economy. That rise of globalization came to an abrupt halt in about 2005. Are we likely to see globalization go into wholesale reversal? We don't think so, but we do think that we are seeing disruptions to global trade. It's not just the tariffs that are being imposed out of the United States, but it's also the influence that geopolitical developments have on world trade and have on global supply chains. If I also think about the way we invest money, as I said, we need to focus on real investment returns. We need to build portfolios that are going to reliably achieve and preferably exceed that real return objective. And to do that, we need to make sure that we've got the broadest range of investment opportunities we can find. As a fund that's looking at managing somewhere near $350 billion, we need a broad investment universe. And it's not just Australian and international shares or cash and fixed income. As Josh has mentioned, we also invest significant amounts of money, around 30% of a typical diversified portfolio, in unlisted or private assets. I want to share with you some of the opportunities that we take advantage of on your behalf. Now, the G'day Group, formerly known as Discovery Parks, has been an investment with ART since 2014. It's delivered very, very good, consistent long-term returns. It's a superbly managed business. Over the decade that we've owned it, it's probably delivered returns after all costs in the low double digits. It clearly would have had a challenging time during COVID, but since then, we've seen a very, very strong recovery in the business. It is one of the leading, if not one of, I think it's the largest holiday park operator in Australia, and it's been a terrific investment for ART members for many, many years. Let's go overseas. London Heathrow. We own about 10% of London Heathrow. One of our senior portfolio managers here in Brisbane has a seat on the board of London Heathrow. We expect airport assets like this to deliver longer term returns of, let's say, somewhere between 8 and 12% per annum. We've certainly seen a very, very strong recovery in passenger volumes after the end of COVID. Now we're seeing passenger volumes at all our airport assets return to and actually exceed those 2019 levels. The last 12 months or so, our airports have delivered typically about double-digit returns as that recovery has continued. And finally, let me talk about something that's, I think, particularly of interest to our Australian members, and that is aged care. There remains a very significant shortage of quality aged care facilities in this country. It's not just an Australian problem, it's also a problem in countries such as the UK, where we also invest in aged care. We have currently about 13 or so aged care facilities either under construction or in operation across Australia. The reason we particularly like this sector is that regardless of what happens in the stock market, today, tomorrow, or next week, the residents of these facilities are going to continue to pay their rent. We are not providing the care. We partner with quality aged care providers. They provide the care. We are simply the landlord. We also enforce service standards. If we do lease a facility to a provider, and if the provider doesn't provide adequate care, we can have them removed from the property and put in someone who will. This has also delivered very, very good returns for ART members, while also contributing to an unambiguous social need here in Australia. And we will continue to look for opportunities to invest in this space. Now, finally, let me talk about longer-term investment returns, at least the outlook from here. Now, as part of our annual asset allocation review, we need to formulate long-term assumptions for what sort of investment returns are achievable and sustainable over time. So I'm going to go back to the chart, one of the charts I started with. This is the returns over the past decade. As I said, it was a phenomenal time to be an investor if you were prepared to accept higher levels of risk. More conservative investors went backwards after inflation. Now, what about the next 10 to 20 years? Well, this is the latest numbers that we are working with when we're designing portfolios. So this is the 20-year forward return assumption that we use as part of our strategic asset allocation design. Several observations I want to make here. Firstly, will I still get rewarded for taking risk over the coming decade and beyond? In other words, will there be a return premium that I can generate if I'm prepared to accept the volatility that share markets provide? The short answer is yes. Perhaps not as attractive as the last decade, but certainly I do expect to get that return premium. I hope I'm wrong. I hope the next decade is exactly like the last. But frankly, investing is like life in general. I'd much rather be pleasantly surprised than bitterly disappointed. So equities provide a return premium. Secondly, am I likely to get a premium if I invest in private or unlisted assets? Am I likely to be compensated for the fact that I can't simply get on the phone right now and sell our stake in Brisbane Airport? And again, the answer is yes. However, we don't expect that return premium to be quite as strong as it was in the past decade. But nevertheless, we expect a return premium from those assets. And finally, on this chart, the next decade, am I likely to be punished for my conservatism? And the answer, we think, is no, because we've seen interest rates rise, because the yield on offer in global bond markets has risen to more reasonable levels, I can invest in these assets and have much greater confidence in the likelihood that I'll get a positive real return. That is the silver lining to the cloud of higher interest rates. And before I hand you back to Josh, let me just leave you with some of the sort of enduring messages that we like to communicate to members during what remains fairly challenging times in the world. Look, super is the longest term investment we will ever have. Crises, as part of any long-term investment journey, crises happen, market downturns happen, recessions happen. They are inevitable. They are part and parcel of a long-term investment journey. We can't really predict them in advance, and we can't identify exactly when they're going to come to an end. We simply know, and we can't design portfolios that way. Our job is to design portfolios that deliver on those long-term return objectives. And the other thing that I think it's worth remembering, when you do face a crisis, when you do see a recession or a major market downturn, every crisis, every bear market, every recession comes to an end, bar none. There is always a light at the end of the tunnel, and it's not a train, it's the end of the tunnel. And with that, I'll hand you back to Josh.
Thank you very much, Brian Parker. Even pre-recorded, you're energetic and dynamic. Ruth, wonderful to be at the desk for the first time tonight. How are you?
I'm good. It's good to have you here. I was getting a bit lonely over here in the corner by myself earlier.
So what Ruth and I are going to do now is just wrap up a bit on the investments that Brian was talking to. We'll then talk very briefly on considerations around insurance as you plan and enter into retirement. And then we'll open up for Q&A. We've had some wonderful questions coming in, but again, we encourage you, if you've got any questions, now's your time to really put those in, and our moderators will feed those through to us. Now, as Brian was talking about, there are a lot of assets that we invest in. And if we cut to some of our content here, we can see that we've got amongst our investment options what we call asset class options. And these really specifically go into the investment classes or the asset classes that Brian was really identifying and speaking to. What we show here in these graphics is actually the exposure that each of those different investments have to those assets and what is considered a growth asset and a defensive asset. So in thinking about what we were saying prior to Brian's video, those growth assets will come with higher risk, but they also, to some of the charts that Brian spoke to, give greater potential for return. You then see on the flip side some of those assets like bonds and cash, for example, that give you much greater security or comfort in that they're not exposed to as much risk, but they're also not going to give you that return potential. So to try and build the best of both those worlds, we also offer a range of diversified options. And these have names that really try and describe that type of objective or outcome that I've shown on the previous slide. What are they trying to achieve? The high growth option will have a lot of assets like shares, property, private capital, and only a little portion invested in things like cash and bonds, which means that it brings with it a lot of those risk exposures. As you go down the chart, you can see those risk exposures changing and really being reflected in their names between things like growth, conservative on the opposite end of that scale, and somewhere in between a name like balanced. So when it comes to your superannuation, although we invest on your behalf, ultimately you have the final say as to how your balance is invested. You have 16 investment options that you can choose from, including those asset class options I just highlighted, as well as those diversified or multi-asset classes I just showed. You can choose as many options as you like, as often as you like. And that can be done very easily through the mobile app, online, or by giving us a call. But I encourage you, before you make any investment change, to explore how you feel about your investments. Your choice with your investments really has two key elements for you to consider: how you'll emotionally respond to events. How will you feel if markets fall dramatically? How will you feel if there is volatility? And you need to assess that. But the second thing to also consider is what sort of returns do you expect and want? What you might actually find is that those two things don't necessarily marry up. And so doing something like an investment profiler tool, which we're showing on the screen here, helps you to understand how you feel as an investor and how you might need some more comfort. Failing that, I encourage you, where you've got your own financial advisor, and if you're feeling concerned or worried or nervous about your investments, reach out to them. And if you don't have a financial advisor already, feel free to reach out to us to deepen that discussion. Now, picking up on something that we discussed last week, your retirement is something that for many of us comes with a little bit of uncertainty. You might remember, for those of you who joined last week, that really for those of us who retire early, so in our 50s or even early 60s, that often that decision doesn't come as a result of our planning or our choice. Usually, early retirement comes because of our own ill health or the ill health of a partner or perhaps the ill health of an elderly parent. It is important in that context that you think about the insurance that you have in your superannuation. Generally, your insurance will cease around the age of 65. And that's because as you approach retirement, you start to see that you have greater pools of assets. You also have access, probably in the near future, to government benefits such as the age pension. And so therefore, the position and the importance of insurance actually starts to reduce. So when you approach retirement, it isn't just thinking about how much you have saved, but it is also thinking about what protection you might need on those savings in the event that something happens to you. So you should consider in assessing that. As you approach retirement, do you still have debt? We know that typically about half of Australians will retire with some form of significant debt, such as a mortgage or a personal loan or other debt that they may be carrying for their children, for example. What liabilities do you have, and do you still have dependents who actually need you to help support them? If your answer to any of those is yes, you maybe need to consider that your insurance is still important to you. But as you start to approach retirement, you might see that some of those things don't become such a priority. Also consider as you approach retirement, how are your savings growing? And what entitlements are you going to soon get access to, as I said, such as the age pension? As those things become closer, as those things are something that you can access sooner, then again, your insurance might be something that you become less reliant on. And the third thing to weigh up is that insurance, as you get older, becomes far, far more expensive. That insurance has a cost, and that is deducted from your account balance. So as you're approaching retirement and really wanting to accumulate your balance, you see that potentially, especially if you're winding back work, costs for insurance premiums can start to drag on your balance. And that's why it's important that you weigh up what insurance you need, if any. So as you approach retirement, do think about how this fits into your retirement planning. But to go into a tiny bit more detail, I'll hand back to Ruth.
Thank you, Josh. I thought I would just run through with our audience tonight the different types of insurance that you might actually see on your account. Now, the first two we're looking at here are what we call default insurances. Almost everybody, unless they opt out of having insurance, will at some point in their superannuation journey have some death cover and total permanent disablement cover applied to their account or attached to their account. Now, remember what death cover is. It's almost like life insurance. It's really a lump sum of money that would get paid out in addition to your superannuation balance in the event that you've passed away. And total and permanent disablement insurance is also a lump sum, and that gets paid out as well as your super, of course, in the event that you're deemed to be so sick or so injured that you'll not be able to return to work again. And like I said, for most Australians, There will be some criteria early on in your superannuation journey, but for most of us, we will at some point have both of these insurances attached to our accounts. Now, it's generally quite connected to your age. You might have quite a lot of this when you're young, and it might start to scale back a bit as you get older. And of course, to Josh's point, that's because we want to strike a balance between protecting you and your loved ones in the event something does go wrong, but understanding that it's also a cost on your retirement savings. And we hope as a super fund that we don't have to pay too many of these benefits out, because that means something has gone wrong for you and has not been part of your plan. We want you to get into retirement and enjoy those retirement years. So just have a look at your account and see if there is some insurances attached there. And as Josh said, reassess if that's still something you need. Now, the third type, and these are the only three you can have in superannuation, the third type is income protection. Look, this is generally not applied by default. In some cases, it will be, depending if your employer has a particular arrangement or if you work for a particular department in Queensland Government, you might have income protection applied by default. So really important to have a look at your account and your statement to see what kinds of insurance are on there. Remember, income protection replaces a part of your salary in the event that you're injured or sick in the shorter term and just need to have that feed of income coming through into the bank account. Remember, these types of insurances don't stay on there forever. They do eventually expire. And that can vary as well, depending on the type of account that you hold at Australian Retirement Trust. There may be an expiry of age 65, whereby all your insurances will just naturally have fallen off anyway. Sometimes it might be 67, and in certain scenarios, it could be 70 for your death cover, for example. So just be mindful of when it's going to just naturally expire anyway for you. So when we think about insurances, we're generally, particularly when it comes to death insurance, we don't buy death insurance for our own benefits. It's the type of insurance that we're purchasing so that that money can be paid out to our loved ones, be that our spouse, our partners, our kids, whoever that might be. And like I said, it gets paid out if there is some there, in addition to the super balance. One of the things that is very alarming to those of us who work in the industry is the number of Australians. There are millions of Australians walking around who have never told their superannuation fund who they would like their super and any life insurance that's still there, who they would like it to be paid to in the event that they do pass away. Remember, your superannuation is not an asset automatically under your will. So many of you in here this evening might have a will, but your super is not necessarily going to be paid into your will by default. It very often will go straight from the super fund to an individual. And there is a hierarchy, and we'll talk about who you can nominate and who the super funds can pay it to. But it is really important that you take that control back yourself and you nominate a beneficiary. If you do not have a beneficiary, then it is upon the fund to try and determine who would be the relevant person. And that's not a quick process. We don't know all of you personally or what your wishes might have been. We will talk in a moment about who you can consider nominating and who the super fund would consider paying it to. So to control that, we strongly suggest that you consider putting a binding beneficiary in place. This is a legal agreement between yourself and your super fund that in the event of your passing, they must pay the superannuation benefits to that person or those people. You can have more than one. Now, there will be rules around who you can nominate on there. However, if you do decide that you would like the superannuation to be paid to your estate, maybe you have some conditions attached to receiving the money, etc., and you don't just want it to be paid as a lump sum, you can direct the super fund to pay that death benefit, which is your super balance plus any insurance, over to your estate by just selecting your legal personal representative. Now, I talked about the fact that there are some rules around who you can nominate and, of course, some rules around who the superannuation fund would go looking for if you didn't have a nomination. This, Josh, is often a question we get asked, and it causes an awful lot of confusion and sometimes concern with people. So maybe help the audience understand what the rules are around who you can put on there as a beneficiary.
Thank you, Ruth. And yes, there are within superannuation some very tight restrictions as to who you can nominate. And there's also some issues around taxation, which is something that we're going to talk to in a later session. But really, the people that you can nominate are going to be your spouse, including a de facto of the same or different sex. It is also any child, but it has to be not a niece, not a nephew, not a child you like. It has to be a child of your descendants, so an adopted child or a child through birth. A person in an interdependent relationship with you. Now, what that means is that's someone who shares both a personal dependency upon you as well as a financial dependency. So that could be someone who you're living with, that you're caring for. It could also be someone you're living with where you're sharing domestic duties as well as sharing expenses. So to give you an example, before I was married, when I moved out of home, I actually lived with my brother. And while I was living with him, we actually had a joint mortgage. We actually took care of the house together and cook meals together and things like that. So that actually translated to an interdependent relationship. An interdependent relationship could also be that you're a flatmate with someone. Okay, so this could be where you live with someone, you've lived with them with some time, you're sharing expenses, but you're also sharing duties. It may also be where you're living with someone to care for them. So it's very, very important to understand what that is, but also to understand what it isn't. The other condition of a person that you can nominate is what we call a financial dependent. And this can't be someone that you just give money to, such as an elderly parent, if I use that example. It has to be that they are absolutely financially dependent upon you, and that can be proven for their well-being. So the rules here really, outside of it being a spouse or a child, actually get quite difficult. And so that's why you have to consider this carefully. The other nomination, which Ruth had already mentioned, is if you don't have anyone who fulfills one of those, or if you actually want more certainty around it, if your situation is a complicated one, then that's where you can actually have a will in place and have instructions within that will about how your estate will be distributed. You then make your nomination for your super fund that in the event of your passing, we will pay in accordance with the will. Now, as I said, there are also tax considerations around all of this. Some of the people listed will receive death benefits tax-free. Others will have tax applied depending on age and circumstances. This is something that we're going to cover off, though, in a later topic. But just for the purposes of this evening, be very aware that A, it is important that you have a nomination in place, but B, there are restrictions on who you in fact can nominate. So I think before we go to Q&A, it's also important that you just check the level of insurance you've got. Check the beneficiaries that you do have nominated, and you can do that both through the mobile app as well as online, or failing both of those, give us a call to assist you. You'll also have that information within your annual statement, which would have been recently sent out to you. So please take the time to check in on that, make sure that it is right. It's a benefit we don't really want to think about, and we often don't want to talk about when it comes to our superannuation, but it is a vital one. As Ruth said, in the event that you've had an event occur, that you've passed away or become injured, this becomes very important for your dependents. It's not so much something that you may yourself be dependent on, but those that you leave behind. If you do want to know more about anything that we've covered off tonight, including your insurance, as I said, please do jump online and explore that. But what is it that you should be thinking about from this evening? Well, there's a couple of things that we really encourage you to do. To explore contributions but also to use our contributions calculator to identify not just whether you should contribute to super, but the best way for you to do that and what benefits that could provide to you, including taxation. Also undertake, when it comes to investments, that risk profiler quiz. So think about how you may be invested and how you can sleep easier at night. As Brian says, if you're taking too much investment risk, if you're not sleeping at night, you should do something about it. And doing a risk profile quiz is a really great way of engaging with that. As we've just outlined, please also review your insurance needs, remembering that there is a balance between protecting yourself and your loved ones in the event something occurs, but also recognising there is a cost associated with that protection that increases as you age. And also, especially if you don't currently have one in place, please consider putting in place a binding nomination. So in the event something happens to you, your wishes are followed. So with that, we would like to open to Q&A, but I encourage you after this event tonight, if you have any further questions, if you want to take any of this discussion further, please do look online at those tools, calculators and other education materials we have, but also reach out to us, or where you've got your own financial advisor already, please reach out to them. And on that note, Ruth, I've actually been seeing in the chat, we've had quite a number of questions come through. I'll start to digest those and think of some to pose to you, but do you have one to get us started?
Yes, I'll actually address one myself, Josh, while you have a quick look through. There was some questions around the binding beneficiaries, and often the questions are around the expiry. So how will I know when it expires? You'll know because we'll alert you to that about 3 months beforehand. And then some questions around the non-lapsing beneficiaries, which is currently not an option for Australian Retirement Trust members. However, we are working on that. So a non-lapsing binding beneficiary is one that doesn't ever expire. You can select that as an option. So I mentioned earlier on that that's something we're working on. And for some product holders, part of the super savings product, that's going to be coming hopefully towards the end of the year. And we're continuing to look at rolling that out as well for our Q Super product holders later on as well. So this is something that we are working on introducing. At the moment, though, as it stands, they do all sit to expire after 3 months. But don't worry, you are informed on that before, well and truly before the expiry date. So just to put that one to bed. And also some questions on how you do it. Forms are on the website. You can print those forms off and complete them, and you can upload them to us digitally, or you can post them back. The return postal address is on the form as well. A couple of questions around...
None of them are easy questions.
No, they're not easy. They're tough, which is why I'll ask and you can answer. How does that sound?
I was hoping to go the other way, but okay.
Look, there is a great question. It kind of covers the full conversation that we had tonight. It factors in contributions as well as investments. And the question was about someone saying, look, I'm concerned about putting in a lump sum contribution into super because I might invest it at the top of the unit prices. Yep. Is there a way I can make the lump sum in super into a cash account just for that lump sum and let my other balance continue to do what it's doing? Such a good question.
Oh, it's a wonderful question. Now, the first thing I'd actually say regarding that is none of us know how to time the market. None of us know when the market's going to reach its peak or when it's going to reach its depths. So trying to actually time a contribution is always difficult. The other thing, though, I'd say is that's an important consideration, because just like perhaps you're concerned about timing a contribution going in at the top of the market, you also don't want to miss the opportunities of being in a market when it's recovering, okay? So if you were to invest that just in cash, for example, are you going to lose that opportunity? When are you going to decide to actually move that money to be fully invested in other ways? So the reason why I say all of that think about there is this beautiful thing that you have when it comes to superannuation called dollar cost averaging. Okay, and what that concept is that you'll put money into your super at different points. Some of that money will go in when markets are high, some of that money will go in when markets are low, but over time that will really balance out. So if it is a really big concern around you with a lump sum, perhaps think about putting it in blocks. But to the other part of your question, can you actually direct where you want that lump sum to go? So if, for example, you've got all your balance invested one way, but you want a contribution to go into a different investment option, what you can actually do is, as part of your investment choice nomination, you can nominate where you want your monies invested. So you can say, I want my balance invested here, but any new monies that come in, I want to direct them somewhere else. You can do that with your investment choice instruction. But I again would actually remind you that it's difficult to time the market. So just keep that in mind, that there is opportunities in also investing big lump sums at certain parts of market cycles.
Thank you, Josh. There's also some questions, I guess, regarding concern people have. If you've got 100,000 or 200,000 sitting in a bank account, that's what we're used to. It feels safe for us. But the reality is that there might be some missed opportunities there as well. If you know that in the short term or even in the next couple of years that you really have no need for that as cash flow. So I wonder, I'm just paraphrasing one of the questions here, but it was about, look, would it just be safer, and would I be better off to leave my money in my bank account? And what are the advantages of actually thinking about putting it into superannuation?
So a couple of things. Firstly, if you're investing in a bank account, you've got to recognise that it will probably only generate a cash return. Okay, so much like Brian talked about in his charts, it's probably not going to deliver the outcome that you would want or the outcome that you would expect in terms of returns. So that's the first thing, that investing in a bank account isn't going to necessarily give you performance. The second thing to consider is that investing in a bank account means it's fully accessible. So it's declared in your tax return. Any interest that you earn, as little as it may be in the context of what I've just said, that's going to be counted as accessible income and you'll pay full tax on it. Whereas if it is in superannuation, while you're saving, accumulating in super, any investment earnings are taxed at a concessional rate of up to 15%. And if you actually start a retirement income account, any investment earnings are in fact tax-free. So there is also a tax difference. So I would say that putting it into a bank account might make you feel safer in some regard, but I'd actually say, why wouldn't it then be better to still put it in super, but to look at those other investment options we have, such as our conservative option, as an example.
The cash option, I guess it is still another option. There was a question about making contributions if already retired. So I talked earlier on about some personal factors to think about before you make contributions, and it could vary across the audience. And one thing to be mindful of is your balance. Once your superannuation balance does hit the $2 million mark, well, then you can't make any more contributions. But remember, age is another factor. It's not based on whether you're working or not. You can still make after-tax contributions regardless of whether you're working or retired. So if you are retired, yes, of course, you can still contribute into superannuation, assuming that your balance hasn't gone over the 2 million. And of course, assuming that you're not more than 75 years old. Then, of course, you still can contribute into superannuation. And the way you do that is, if you wanted to do it online, you just log into your account online, your biller code and your reference number are on there. So you can just do it digitally if that's your preference. Or, some people still do like to maybe complete a form and pop in and see us at George Street in Brisbane. If you're local, you can come in and we can support you with that as well. But absolutely, you can contribute even if you are retired.
And a jargon question here, we were actually asked by someone, what is private equity? I referred to private equity after Brian spoke. Private equity is those investments or those assets we invest in that Brian spoke to that are large companies that we invest in, such as the G'day Group, that aren't listed on the share market. So these are large companies that are producing strong returns for our members, strong capital growth as well, but we're privately investing in those as opposed to investing in them through the share market. It is actually a huge part of the investment market. So if I think about large companies in America, for example, only about a third of those companies are actually listed on the share market. The other 2/3 are privately owned. So there's really great opportunity there for us to actually consider.
There is a really good question, and I don't even know if it's a question or more a statement, and I'd like you to comment on it as well. The question is around when you're talking to a financial advisor and the question around investment options and how should I invest my superannuation, or if I'm about to retire, how should I invest my income account? And financial advisors will often talk about how, volatility will always be something to think about, but markets recover higher than they were before. Would it not be better then, rather than asking what is your investment appetite, to actually display for people what has happened in the past, maybe through the graphs that we've got available on our websites, and get them to reflect on what they feel on the visual of how that 10,000, for example, might have tracked for the last 20 or 30 odd years? I think it's a really good question, or a really good observation.
It is a wonderful observation. I think what financial advisors are trying to do is balance on telling you what has happened historically, remembering they can't forecast what's going to happen in the future. As Brian often refers to, if even he as the chief economist could predict the future, he probably wouldn't be working anymore. So financial advisors certainly can talk about the behaviour of investments and assets historically, but they certainly can't predict as to what things are going to do. And that's why often when you sit with a financial advisor, they'll talk to you about how you will feel about volatility and things like that. And they will also give you different glide paths or options. So they will often say that these are different expectations we have around these investments if they were to earn X amount or Y amount or Z amount. It gives you an idea as to where different paths may go depending on investment returns into the future. If I can put it to you though, and it's actually something we talk about a bit in next week's episode, in looking at historical return, and thinking about the impact of decisions that you may have made 10 or 20 years ago and how they could impact your super today and into the future. It is a really good way of assessing what's happened. It can also be a way of kicking yourself a bit about the opportunities you've missed. So I think it's using that history to use as a guide, but just remembering history doesn't always define the future.
Yeah.
So
Good. You got time for one more?
I think we do.
We can't talk about investments without getting a question about crypto. So we will wrap it up on this, but just make a very quick comment, Josh, around whether ART invests in crypto.
The short answer is no, we don't. But I don't want to say it's not something that we're aware of. So cryptocurrency is something that we do see as having definitely investment potential. Certainly a lot in the technology that actually is the basis of cryptocurrency. I would say where we're wary of cryptocurrency itself is that it's largely unregulated. And although we are seeing some countries regulating cryptocurrency more, it probably isn't to a point that we feel secure about it. The other thing is that with cryptocurrency is, to be frank, it's not easy to define in what it's going to do. Cryptocurrency history doesn't give a good indication of what it can do into the future. Cryptocurrency can move based on a tweet, based on a comment, based on sudden sentiment shift. And that isn't something that we believe should be where people invest their retirement savings. With saying that, as I said, it's something we remain attuned to, but certainly that technology, the basis, the blockchain basis of crypto is something that does interest us. So I'll never say never, but I'll also say that we may not look at a pure cryptocurrency investment unless we see countries actually take a more regulated stance or having their own versions of cryptocurrency. The only other thing I want to reflect on, because it's a question we've been getting a lot on the road and maybe we'll end off here, is that we've also been asked questions around, are we investing in commodities like gold, for example? It's important to know that, yes, we do have some exposure to those as part of our broader diversified assets, and they're assets like many others that we hold that we do invest for a long-term performance. So we've seen gold going very well in recent times, a lot of people moving to it with broader uncertainty. Know that it is part of the assets we invest in, but it certainly isn't a significant asset that we hold, nor is it something we give people direct investment capability into. On that note, I would like to thank you all for joining. I would like to thank you, Ruth, for sharing your expertise this morning and holding the fort here at the desk while I was off in the other studio. And if I can also thank our wonderful team in the background. To all of you, have a wonderful end of the week, a wonderful weekend, and we will see you here next Wednesday night.
Hey, Sue!
Bev, you're sitting on a monster.
Literally and figuratively. It's my superannuation from Australian Retirement Trust.
Australian Retirement Trust. Right.
Big, isn't it? Comes with an app.
I gotta get me one of those.
One day, I'll unleash it on the world, maybe even Barbados. Barbados, baby!
Awaken your super with Australian Retirement Trust.